Let's take a look at problem 9 and somewhat differentiate it from exercise 18. What we can see is that this is an installment note that we're receiving $20,000 a year for 4 years. What we don't know is what's the value of that note today. So we're just going to plug in, there's to our calculators, there's 4 periods. We are given an interest rate of 11%. We don't know the present value. We know the payments are $20,000 a year. And there is no lump sum in the future, so there's no future value. So we key all of that in, and we're going to get a present value of $62,049. So that's what we want to record as our note receivable. Okay, so what we will do, just like we did in exercise 18, and the note receivable will be the future amounts of this note. So that's going to be the $20,000 for 4 years. So we're going to put the gross amount in notes receivable, and then we're going to net that, the difference, $17,951, so that we have a net amount of the note receivable, $62,049. Okay? All right, so we know that in addition to the note, we received the note today. We also received cash today in that homework problem. There was a down payment by the customer of $40,000 plus this note. The total amount of revenue earned would be the cash amount plus the note. So those are the total present values today. We get $40,000 today, $62,049 today. Total revenue earned $102,049. Okay, so let's go down here then. So we can track, if we're going to post, we've got $80,000 in our note receivable. And then we have a discount of $17,951. And that's at the very beginning of the note. And then a year will go by and we will calculate interest revenue, right? Remember, it's going to be at 11%. So we've got a carrying amount of this note, or net amount, our real principal, the real principal on the note, in effect, is the $62,049. We take that times 11%, and we'll get this $68.25. Okay, so we're going to record that $68.25 just like we've been doing before. We're going to reduce the discount and record interest revenue for that $68.25 because the discount still represents future interest revenue, right? This discount represents future interest for us. What's different is that we're also receiving cash. This cash is going to reduce our notes receivable. So after the first payment, right, go back up here, after this first payment, there's only $60,000 left of installment payments to receive. So let's go take a peek at what that journal entry is going to look like. We're going to reduce the note receivable because cash comes in. So now there's 2 journal entries, one for the interest and one for the installment payment received. Okay, so then if we had $17,951 in the discount, if we reduced it $68.25, our new balance is going to be $11,126. $11,126. Remember, we had $17,951 in there. We made an entry to reduce it by this amount. So here's our new balance. That's the end of the first year. Let's go to the end of the second year. Again, we'll have a $20,000 payment, and that's going to reduce our note down to $40,000. So now, at the end of the second payment, there's only $40,000 left of future payments. Also, we have a net balance, this $48,874. That's our real principal. We're going to earn 11% on that to get the $53.76. Again, 11% times this $48,874 gives us this $53.76. And then this $53.76 is going to reduce the $11.26. Let's go take a peek at that journal entry again. So the second year, again, we've got the cash payment, reducing the note, and then we've got this $53.76 reducing the discount and recording interest earned. Okay, so let's go back and look at how we're going to reduce the discount in our schedule. So it had a balance of 11,126. We're reducing it, this 5376. So now our balance is 5,750. And then we just keep going on with that. The third year, there will be another $20,000 payment, reducing our total note receivable to 20. At the end of the third year, there's only 20,000 left. We also take this last year's ending carrying value times 11% to get the 3768. That 3768 will come out of the discount, and now the discount will have a balance of 1,982. Okay? And then at the end of the fourth year, our final payment, after that 20,000, there's no note receivable. We'll take the 18,018 times 11%, arrive at this 1982. The 1982 then reduces our discount down to 0, and we're all finished. Okay, so that's going through all of that, and then, again, over here, you can see it's always the same accounts, the same journal entry. What changes is the dollar amounts based on that amortization, this amortization schedule. Now, you are going to have an assignment where you're going to put this in Excel. This, here you've already got your headings, so that's somewhat already planned out for you. You are welcome. If you want to rearrange some of these headings, you're welcome to do that. But you are the one that's going to have to put in the formulas. So when you go to Excel, you want to have this input area, and then all of this down here should be formulas. All of this can be formulas based on numbers up here. Okay? All right, so that is problem 9 for us.